Are you throwing away money on insurance premiums because you set your deductibles once and never looked at them again? Most people pick a deductible when they buy a policy and they never think about it. Meanwhile, their life has changed, their savings have grown, but they're still paying premiums like it's 10 years ago. Today, we're talking about insurance deductibles and a strategy to make them work for you instead of against you. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Let me tell you about a conversation I had last week. A couple in their early 60s had been with the same insurance company for 20 years. Good people, responsible always, paid their bills on time. When I asked about their auto insurance deductible, they said $250. Homeowners, also $250. So I asked them why they set those deductibles. When we first bought our house, they said that was 1985. Their financial situation today, completely different. Retirement accounts, substantial savings, home paid off. But they were still paying premiums based on decisions they made when they were 28 years old with 2 kids and no emergency fund. Here's what most people don't understand about insurance deductibles. The relationship is simple. High deductible, lower premium. Lower deductible, higher premium. Everyone knows this in theory, but knowing it and actually reviewing it, two different things. The real question isn't what deductible you have, it's whether that deductible still makes sense for your current situation. When you're young, maybe you've got limited savings, kids at home, tight budget. A low deductible makes sense. You're trading higher monthly premiums for the security of knowing you won't face a big out-of-pocket expense if something happens. But what about 20 years later? You've built up savings, your kids are grown, you've got an emergency fund. Now that low deductible is just costing you money every single month. That couple I mentioned, we ran the numbers. By increasing their deductibles to $1,000 on both policies, they'd save about $425 a year every year. Now, here's where it gets interesting. I told them to shop their insurance, get quotes from 3 or 4 companies, see what's out there. When's the last time you actually shopped your insurance? Most people stay with the same company for decades because it's easy. But easy isn't always smart. They shopped around, found another carrier with better rates and a higher deductible. Now they're saving even more, close to $600 a year total. But here's what I really want you to hear. What if you're not comfortable with a higher deductible? What if you don't have that emergency fund built up yet? There's a strategy for that. Take the difference between what you're paying now with the low deductible and what you pay with a higher deductible. Let's say it's $50 a month. Instead of sending that $50 to the insurance company every month, put it in a Roth IRA. Now, you got to talk to your financial advisor and CPA. I'm not giving tax advice or financial advice, but think about what this does. You're building your own safety net. That $50 a month grows tax-free. After a year, you've got $600 plus whatever it earned. After 2 years, you've got enough to cover even a high deductible if you need it. And if you don't need it, that money keeps growing tax-free for your retirement. And then consider increasing the deductible again. Compare that to paying the insurance company extra premiums every month. That money's gone. You never see it again. You're renting protection you're statistically unlikely to use. With the Roth IRA approach, you're building an asset, safety, liquidity, and return. You've got the safety because the money's there if you need it. You've got the liquidity because you can access your contributions anytime. And you've got return because it's growing tax-free. I had a listener implement this strategy about 5 years ago. She was nervous about raising her deductible from $500 to $2,500, a big jump. But she started putting $75 a month into a Roth IRA. That's what she was saving on premiums. Guess what? In 5 years, she's never filed a claim. That $75 a month has turned into about $5,000 in a Roth IRA. If she kept that low deductible, she would have sent that money to the insurance company and had nothing to show for it. Now, some of you are thinking, Ron, what if I have a claim in year 1 before I've built up that fund? Fair question. You need to come up with the higher deductible amount. But here's the thing. Most people don't file claims every year. If you're filing claims that often, you've got a bigger problems and your rates are going up anyway. The math works in your favor. You're far more likely to save money over time with a higher deductible than to come out ahead with a low one. And remember, the relationship between deductibles and premiums isn't the same across all types of insurance. You might save a lot by raising your auto insurance deductible, but less on your homeowner's policy. It depends on your specific situation, your insurance company, your age, and where you live. This is why you need to shop. Call 3 or 4 companies. Get actual quotes with different deductibles. Look at the real numbers. Don't just assume your current company is giving you the best deal. Now, if you don't want to spend your time calling around to different insurance companies, I work with some great insurance agents who can do this for you. They'll shop multiple carriers, compare coverage and deductibles, and give you a second opinion on what you're currently paying. Sometimes having a professional look at your policies reveals gaps in coverage you didn't even know you had, or coverage you're paying for that you don't actually need. I worked with a business owner who had 6 different insurance policies: auto, home, umbrella, business liability, the works. He couldn't remember the last time he reviewed any of them. We connected him with an insurance agent who shopped the whole package. He ended up switching companies and adjusting deductibles. Saved almost $2,000 a year. $2,000. We set up a strategy where half went to paying down debt and half went into a Roth IRA as his insurance reserve. After 2 years, he had $2,000 built up, way more than enough to cover any deductible, and it kept growing. That's $2,000 a year that was going to insurance companies, now working for him instead. Strategy beats rate always. Now, I'm not saying everyone should run out and get the highest deductible possible. Some people should keep low deductibles. If you absolutely cannot handle a higher out-of-pocket cost, then the peace of mind is worth that extra premium. That's a valid choice, but make it an intentional choice based on your current situation, not a decision you made years ago and never revisited. Here's what you should do. First shop your insurance, all of it, auto, home, umbrella, if you have it. Get quotes from at least 3 companies. Look at different deductible levels. See what the actual savings are, and if you want help with that, reach out. We can connect you with an insurance agent who will give you a thorough second opinion at no cost to you. Second, if you decide to raise your deductibles, set up that Roth IRA. Take the premium savings and redirect it. Build your own reserve fund, one that grows tax-free and actually belongs to you. Remember, check with your tax professionals and financial advisors. Third, make this an annual review, not every 20 years. Every year during open enrollment or when your policies renew, your situation changes. Rates change, companies change. Stay on top of it. Your insurance deductibles are part of your overall household budget. They affect your cash flow every month. Get them right, and you free up money for things that actually build wealth. Get them wrong, and you're sending unnecessary money out the door year after year. Look, your insurance deductibles are just one piece of getting your financial house in order, but that's an important piece that most people completely ignore. I've put together a free tool that walks you through organizing all of this: your insurance, your debt, your monthly cash flow, everything. Because you can't make good decisions about one piece without understanding how it fits with everything else. Get the tool, rsrlinks.com/keysteps. rsrlinks.com/keysteps. It'll help you look at your complete financial situation, including those insurance deductibles you probably haven't thought about in years. And if you want an introduction to a great insurance agent who can give you a second opinion on your coverage, just let us know when you reach out. Shop your insurance, consider that higher deductible, use a Roth IRA to hold the savings, build wealth instead of just paying premiums. rsrlinks.com/keysteps. Get your financial house in order. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. I'll speak to you next time. That is the Your Credit Matters segment, brought to you by rsrlinks.com/debt-free. rsrlinks.com/debt-free.